Is Disney finally cheap enough to buy? Due to their prestigious name and business, their stock has been priced quite expensively over the years, and the addition of Disney Plus and the stimulus in the markets definitely added to that. However, the stock has halved since the 2021 highs. And so we have to ask ourselves, is Disney now a worthy addition to our portfolio? Will this earnings release prop the stock higher, or will the stock begin to decline from these levels? Keep watching to find out, as we'll be talking about that and more on today's episode. How's it going? Welcome to Everything Investing. I'll be having a great day. With that being said, today we're going to take a look at Disney's Q2 2022 earnings results, where we'll do a deep analysis into the financials. We'll then take a look at the technical setups to see what is exactly going on with Disney. And as you can see, we are down literally 50% from those highs. And then we'll conclude with the valuation of this business to see at what price we can pick up shares of Disney for at a margin of safety. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. All right, investors, so let's see what has transpired with Disney from a technical perspective over the last few years. So if I scroll back, we can see that Disney has been quite a good compounder pretty much since its inception, and it's just really gone higher and higher, right? Now, the only issue is we've now reached all-time highs back in 2021, which is up near this $200 per share figure. And since we've reached this level, we have fallen off a cliff once again, and we're down to, we've literally have from $200 per share to now $100 per share. We do have these blue lines in here as our support and resistance levels, and then we have this green zone at the bottom here, which is going to be our long-term buy zone. As you can see, we've held up quite well every time we entered into this range, and we've always rejected and we've gone higher once we were above this. So it remains to be seen. Will this happen again once we reach down? And really, that's only $10 away from where we currently are, $10 to $20 away. So will this happen again? Will we see a nice rebound in the stock once we reach into $90 per share? Because that looks like where we are going at the current point in time. But we also can see that there are a lot of blue lines in this area, which means there's a lot of support in this stock in around these price ranges. As you can see, price has actually rejected off of these zones already, and now we're poised to go higher from here. So over the next few weeks, as the market digests this earnings results here, we're really going to see, are we going to go higher? We have some overhead resistance here that are nearby, and if not, if we go lower, we do have some support here. And then finally, once we enter our buy zone down here, we're going to have to see what exactly is the market thinking about these most recent earnings results, which we're going to go through in just a second. But that is the technical setup for right now. Let's see where Disney goes from here. So with that, guys, let's jump into the earnings highlights here to see what analysts thought and expected of this recent Q2 results. All right, so let's start with revenue. They came in at about $19.2 billion worth. This is actually up 23% year over year. However, this did miss analyst expectations by almost $1 billion. So we'll take note of that when it comes to the actual financials that we dive into here. In terms of the earnings per share, they came in at about $1.08. Again, they actually missed analyst expectations again by about 11 cents. And if we look at point number 2 here, they mentioned that their earnings per share from continuing operations for the quarter decreased from 26 cents from 50 cents in the prior year quarter. So not good there at Disney. They are a maturing business, and with maturing businesses, we do see a slow in growth. But what we don't want to see necessarily are decreases in their financial metrics. Now, that being said, Disney Plus subscribers did come in for about an increase of about 8 million new users from Q4 2021. So that's definitely a plus for investors. And in terms of their outlook, they did not touch too much on it, but we do know they're going to be investing in growth with their new movies. We have Marvel, Star Wars, etc. But with that being said, guys, let's jump into the financials and actually analyze what's going on with Disney and their financial statements. All right, so let's start with the revenues here. As we just spoke about, last year we had about $15.6 billion. Now we're up to $19.2 billion for this most recent quarter. Now, to achieve those revenues, we had costs and expenses last year of $14.1 billion. We now have $17.6 billion in costs, okay? We add in our other expenses and whatnot, and we get to our income from continuing operations before taxes. Last year was actually at $1.2 billion. Now we're at $1.1 billion. Next, we have to deduct some taxes. And last year we only had $100 million to deduct. This year we have $500 million to deduct. And so when we calculate this results in a net income from continuing operations. Last year, $1.1 billion. This year, down to 600 million. So we're seeing some deterioration there, but it is really due to the income taxes from continuing operations. And so without the increase in taxes, yeah, we're relatively flat year over year, but it is something that you could expect from a business that is as old as Disney is. Okay, when we look at this from a 6 months perspective, yeah, we're going to see similar things. Our income here from operations did increase quite substantially over the 6 month period, and that actually resulted in a positive gain here from our net income from continuing operations. So ultimately, if we look at this from a 6 months perspective, we actually did quite well, and we have seen top and bottom line growth there. It looks like we just had a bad quarter for Q2. Now if we scroll down here in terms of our balance sheet, let's just take a look to see debt serviceability and cash. We can see cash and cash equivalents at this point are $13.2 billion. Last year was $15.9 billion. So we have lost a little bit of cash. We've spent it on some things, which we will see in just a little bit here. But when we look at the liability side of things, if we scroll down, let's see what kind of debt we're looking at here. So we have about $5.4 billion in current portion of borrowings, and then long-term borrowings, we have about $46.6 billion. So let's just round it together and say that we have about $50 billion worth in debt for Disney. Now, if we compare this $50 billion figure with our current cash and cash equivalents, yeah, we only have $13 billion in cash. And even if we use our total current assets, that's only $31 billion. That being said, Disney does have total assets of $200 billion. They have a ton of licensed content. They also obviously have their parks and recreations here and other land and projects in progress. So, I mean, yeah, the debt is definitely serviceable for Disney. It's just typically would like to see that the debt is serviceable with the cash on hand. But for Disney, this isn't a problem. With that being said, guys, let's move on here to the statement of cash flows and see what kind of free cash flow metrics Disney is pulling out of there. And actually, they give us the 6 month ended figure here. So that'll be a little bit easier to estimate what they can do on an annual basis. Now, of course, we're going to start with our net income here, $1.8 billion for the 6 months. Add back depreciation, amortization, all of our other non-cash costs here, and we get down to a figure of about $1.5 billion in cash from operating activities, which is pretty good for Disney so far. On an annual basis, we can estimate this is going to be about $3 billion. That being said, we have to move on and deduct some capex here, and they actually spend, looks like, about $2 billion on capex. So they wiped out their operating free cash flow just on capex. So as you can see, this is something that they're spending cash on, and they're really trying to invest in growth and into the business once again, so that they can return some more value back to shareholders. As you can tell, being down 50% does not sit well for many investors or Wall Street in general. So it's definitely going to be their focus, is to bring that share price back up. Now, if we check out their financing activities, we can also see what they've done with some of the cash sitting on hand, and that is they've reduced some of the borrowings or the debt by about $1.4 billion. But with that being said, guys, let's use the information we just received here and put a valuation on Disney as to what we can expect their margin of safety will actually look like, and where we can feel comfortable picking up shares of Disney if you haven't already done so. All right, so let's take a look at their historical results here. And the reason why we have a focus on free cash flow is because it's really the value that they're returning to shareholders immediately, right? So that's why we do like to focus on free cash flow. And as you can see over the years, over the past 10 years, we've gone from $4 billion to 6 to 8 to 9. And then, 2019, 2020 happened. This definitely dropped down to about $1.7 billion. It then got bumped up to about 3.5 billion. And then for 2021, it went down to 2 billion. So we can estimate that for 2022, and based on the operating free cash flow that they did produce, which was about 1.5 billion, we can say that they could probably produce about $3 billion in operating free cash. And that's actually the figure that we will be using for these estimations. And we're actually going to give two different scenarios here. One using this 3 billion number, and then the second, we'll put an optimistic evaluation on Disney as to whether or not they can get back to these numbers over here, where it's $6 to $8 billion, and see what they'd be worth at that point. All right, so jumping in with our calculator here, we've added in our free cash flow figure of about $3 billion, which we expect they can do for the full year of 2022. If they can grow, and again, they are growing at a much slower rate now, guys, so we have to be a little more conservative. Let's say they can grow at 10% for the next 5 years, and then after that, it would decrease to about 5%. On a 20 PE, we can estimate Disney would be worth about $50 billion. If over the next 5 years, they can actually grow at about 15%, which is very optimistic, and then 10% for the subsequent 5 years, with a terminal PE of 25, we can estimate that they'd be worth about $90 billion. Now, if we compare this figure to the current market cap of Disney, we're actually sitting at about $195 billion. So based on our calculator, that doesn't look too great. The thing is, our calculator is looking for a margin of safety valuation for Disney. And there's a lot of different components that are priced into Disney, making the valuation valuation so high, which we discussed at the top of the video. But let's try to be optimistic here and assume that Disney can actually get back to about $6 billion worth of free cash flows per year starting, over the next few years. Let's say they can do it starting back in 2024 to 2025. If we use the same growth metrics, our valuation actually changes quite a bit. So as you can see, from a normal perspective, we would be sitting at about $100 billion in valuations. So that's effectively saying that Disney's worth about $50 per share, which is a little low. And then if we look at our optimistic case here, our calculator actually shows us that it's about a 10% return from these current levels. But really the reason why this looks so bad when we put in our $3 billion figure here, guys, is because of our required return. If we bump that down to, let's say a 6% return, this is a matured business. We're not expecting to get, 10%, 15% from a matured business such as Disney. Then our valuations actually change quite a bit. And if we actually just look for, if this is something you just want to hold in your portfolio as a safe long-term investment, with you're only expecting let's say a 3% return, then yeah, if it falls a little bit down probably to $90 per share, this might be a great addition to your portfolio and you can just come in there and hold the 3% gains that you're probably going to see there. But that's what it comes down to for Disney, guys, at this current point in time. We need to kind of see if they can get back to, pre-2019 levels and see if they can actually produce more free cash flow to reward the shareholders. Because right now, guys, as you can see, their cash flow has really deteriorated over the past few years. So if they can get back here, we might actually have a great investing opportunity for Disney, but that remains to be seen for right now. With that being said, that is all for this analysis. And if you made it this far into the video, please like and consider subscribing for more of this content. And with that being said, I'll see you on the next one.